Mm, This is the fourth episode of the stock market crash course series, and in this episode, we'll be discussing the primary and secondary market. If you've been following the video right from the first episode, I did mention that when a company is issuing shares for the first time, it does that through the process called an IPO, yes, initial public offering. That is the first time the company, which becomes a listed company, is issuing its shares to the general public. Yes, and when this is done, this happens in the primary market. So the primary market is the market where the company itself raises finance directly from the general public. Yes, so when a company becomes a listed company, it has to go through the issuance of an IPO, and the IPO happens in the primary market. So in the primary market, you purchase shares directly from the company. Yes, so you will have to go through your stockbrokers or investment bankers, and they will help you in purchasing the company shares. And when they do that, the money goes directly to the company. So in a primary market, the money used in purchasing the shares goes to the company directly. That is the primary market. And so you buy shares directly from the company. That money reflects on the balance sheet of the company. Yeah. And in the secondary market, that is what happened. After the company have issued shares, you go in, you buy the shares, you are a shareholder of the company. After 1 or 2 years, you decide to sell off your shares. Yes. And in doing that, you sell your shares to another investor who is also willing to invest in that same company. You selling that shares does not mean the company will receive the money from the investor, but you are selling what you have bought from the company directly, or what you have bought from the company to a third party investor. So the investor takes up your rights and obligations within the company. So that is it. And the transaction between the shareholder and the investor happens on the secondary market. So the key distinction here is that in the primary market, the transaction is between the company and the investor. So the money is received by the company. But in the secondary market, the transaction is between an early investor, that is a shareholder, and a new investor. So the money gained from that transaction does not go to the company, or the company do not even get to have a feel of that money. What only happened is that a shareholder has been replaced by another shareholder through a transaction that has been executed between the shareholder and the new investor. Remember, I have told you that on the stock market, investors do not deal directly with shares. They engage intermediaries, which are the investment bankers, stockbrokers, yes, to put it. So that is what happens. So on the secondary market, transaction is between a shareholder and a new investor, and on the primary market is when the company have issued an IPO, or in the course of running business as a listed company, they seek to raise additional finance through equity by issuing shares. So when you buy from the primary market, you are giving money directly to the company, but when you are buying from a secondary market, you are replacing an existing shareholder, and that money goes to the shareholder and not to the company. So the secondary market is very important in helping you to be able to turn your capital into liquid. All right, thanks for watching this video. If you are here to subscribe to the channel, please do subscribe to the channel and like our videos. Yeah. In the next episode, we will be discussing the risks associated with equity or stocks. So, what are the risks that you likely to bear by investing in shares of a company? So, we'll look at that and see whether it is worth your money. Thank you.